Hello, everyone. This is Dr. Duru from Ahan Analytics with the market breadth. Okay, so we finally get a calm weekday. It's a holiday for the US stock market and bond market. And boy, did it actually feel like a good relief. It was much more relief than even the tariff pause. Anyway, but let's go ahead and take a look at the action for the sometimes for the week, mostly for the last day, which was Thursday. Here, as usual, is a snapshot of the big headlines from Yahoo Finance. Nvidia, I've already covered before. That headline says it all. I think one of the biggest things that to happen was Powell basically acknowledging that the Federal Reserve is stuck between a rock and a hard place between inflationary pressures and economic weakness. The president was not happy about that because he wants interest rates to be cut, along with the ECB, the European Central Bank has been cutting rates 7 times actually since their last rate hike. And you can see the headline here that pretty much confirms that Trump is seriously considering trying to figure out how to get rid of Powell, even though by law he technically cannot do it. This is something all traders, investors need to watch very closely. I don't care what political persuasion you have. This is very ominous for US financial markets and the stability of our bond market and our currency. So, as far as I'm concerned, as long as these things are hanging out there as far as potential reality, I think there's going to be a weight on our financial markets as the world stands by nervously. I don't have time to get into all of the reasons why it's very bad to project a central bank that is not independent from the political winds of the country. But it has proven very disastrous for other countries when political leaders get involved directly with central bank monetary policy. All right, let's see. Netflix had a good earnings result. Hertz has continued, the rental car company has continued to soar. And let's see if I can find one more interesting thing. We'll stroll down here. Yes. So the CFPB, I think, the Consumer Financial Protection Bureau, something like that, is now no longer going to be monitoring student loans or medical debt. So that's a big one for consumers. Oh, right. And the housing market. I'm going to go into some charts here for the housing market, but DR Horton basically admitted to a slow spring housing market. And this is something I've written about on my blog at drduru.com/122. I can't wait to read this transcript because, I mean, slow spring housing market has been no surprise to me. I've been calling for this for months. Anyway, it's all right. So those are the headlines, the biggest headlines right now from Yahoo Finance. Let's go ahead and dive into the charts. As always, I like to start with, let's start with the market breadth. What ATs? So AT 50 or above the 50, which is the percentage of stocks trading above their 50-day moving averages, is still in oversold territory. We are now in 11 days of this oversold period. The length and duration of this oversold period is a characteristic of a bear market. And look at this tease. So it got as high as 20.04%, just a bare hair above the oversold threshold, which is at 20%, and then it pulled back to 19.2%. Now, if this were a bull market, I would consider the oversold period all but over. But I am wary, and you can see, of course, that even market breadth has been trending downward here. So I can't call victory, not victory, but I can't call a conclusion just yet. Let's look at the percentage of stocks trading above their 200-day moving averages, which is MMTH. It has been churning. It churned all week, essentially, no real progress at all. And it's still hanging out right at the top of where we had this big surge from the tariff pause. Okay, let me skip over really quickly to Swing Trade Bot to show the overall market conditions. This is actually interesting. Seeing this calm after the storm is a very bullish technical signal. I won't go into the stock scan itself. When I took a quick look, there were a lot of stocks that qualified here, so it took me a while to get down to a very narrow selection. But that's very interesting because this bullish set of technical signals kind of conflicts with some other bearish signals. And I'm just going to scroll really quickly down to the bottom here, where Swing Trade Bot shows its unusually active signals for today. And there's a healthy mix of bearish and bullish signals. These morning stars are basically stocks that look like they finally bottomed, and these shooting stars are basically stocks that look like they have topped out, and they are almost equal, 200 versus 175. But I think this is indicative of what's coming for us is that you're not going to be allowed to get too bearish or too bullish in this market, and we're probably going to see a lot of sideways action as we churn through earnings season now. So let's take a look at what kind of range we're talking about. So here's the S&P 500. Um, you could see that basically the S&P 500 failed at the declining 20-day moving average resistance, which is this dotted line here. It failed there, and then it just stopped. And what I'm thinking is coming for us, coming for the index, is that this downtrending 20-day moving average is going to hold as resistance, but it's going to take a new, fresh bad news catalyst to break down below the low. And remember, I am bracing for this low to be broken because of technical history. You can look back on my previous videos to get some more information on that. But in the meantime, we're probably going to be stuck just kind of bouncing around in here while the market desperately searches for new information, whether positive or negative. The NASDAQ looks similarly. Remember, the NASDAQ had an even more convincing failure at its 20-day moving average, declining 20-day moving average. And of course, I pointed out on Wednesday how it had this very important test of the former all-time high from 2021. And also, it just barely saved itself from a conventional bear market, which is 20% off the all-time high. Note that the NASDAQ was down fractionally on Thursday and once again bounced off that bear market line. So the traders, the technical traders, the algorithms, the robots, they're all clearly watching this line very closely. If conditions weren't so ominous, I would be tempted to just go ahead and automatically buy aggressively from this bounce. But instead, I've been buying very tentatively. So if we do get a good, strong open, not a big gap open, but some positive trading on Monday, I might be inclined to get to aggressively trade the Nasdaq for a continued bounce off of this bear market line up to the resistance here. Okay. And then IWM is our classic case of a stock that's clearly trapped in a trading range between the bear market line and the pre-pandemic high. As usual, I don't have much to say, but it was good to see that it was up 0.8% and outperformed the indices once again. And of course, these small caps are likely the primary driver of market breadth, almost breaking out of the oversold conditions. Take a quick look at the VIX. The volatility index, well, it's holding this uptrend support and not much else to say. The case here supporting churn action is that the VIX, you notice that it's back down to the low of this big day when China retaliated and really freaked out the markets. And I'm suspecting that it could come back down to 20. Well, let's say 24, then maybe 20, but just kind of be stuck in this range and not really get back to the complacent levels of trading that we saw much earlier. Okay. All right. Now let's fly through some individual stocks, some big headliners. United Health Group Incorporated, UNH, had a big, ugly down day. Post earnings day, it lost 22.4%. You can see that this big plunge sliced right below the moving averages, the 200-day moving average, which is the blue line, and the 50-day moving average, which is the red line. So right before earnings, UNH was looking like a place to hide out. And after earnings, that all ended in dramatic fashion. I'm pulling back the chart to just show how critical a level UNH is at now, because it is back down towards the bottom of what's essentially a trading range. And this trading range goes all the way back to late 2021. If sellers are able to maintain momentum, UNH is in big, big, big trouble. So I am definitely not interested in trying to buy into this one. I also don't want to short it either, just because it's overextended to the downside. But if it rallies up to the post earnings gap down, I think it would be subject to a fade. So in other words, bottom line is I have UNH on my bearish shorting list. The exact opposite in healthcare was Eli Lilly, which had great news on a GLP-1 drug. It soared 14.3%, but it stopped right here at resistance, right between the 50-day moving average and the 200-day moving average. And if you scroll back here, you'll see that Lilly actually has its own huge trading range that's been in place since the beginning of 2024. So while Thursday was a big positive day, the stock has a lot of work to do to reestablish some sort of uptrend. Okay. All right. I've been talking about the discount retail stores, and something is up. I don't know what's going on, but Friday was a big day for Dollar General Corporation. It was up 4.2%. I was fortunate enough to have a call option in place on this stock because I was playing a 200-day moving average breakout for DG. This big surge on Thursday is a very positive development. It's not a new recent high, but it has enough momentum to keep pushing. So I think something is up. I can't tell what might be up, but what needs to be true is that Dollar General is somehow able to figure out how to get around its increased costs from tariffs, especially from imported goods from other countries. I think particularly from China. But I also think that investors might be looking at the discount stores because they're increasingly afraid of weakening economic conditions, which will drive more consumers to discount retailers, regardless of what's going on with terrorists, because terrorists will be everywhere and you won't be able to escape. So you might as well get the discounted goods from places like Dollar General. So that's just my speculation and my guess. Let's see how this plays out over time. And of course, as always, remember that this information is for educational purposes. Use your own investment horizon and risk tolerance to develop your own trading strategies and picks. Okay, Walmart, which is the discount retailer we think of most. This is very encouraging. I mean, of course, it tumbled way back in about a month ago, 6.5% post earnings, and it is yet to recover from that loss. But it did hold 200-day moving average support in kind of sloppy fashion, rebounded right into 50-day moving average resistance, and now is holding that line of support. So Walmart is on the comeback trail. And again, I'm taking this as a potential signal of weakening economic conditions. So let's keep an eye on that. I talked about the discretionary. So on the discretionary side, I talked about the ETF XLY, which is the Spider Select Sector Fund Consumer Discretionary. And I decided to go ahead and take a put spread on this one. I think it was for June, May or June. Don't quote me on that. It's a 180 to 170. Basically, if indeed the market break violates the recent lows as I expect it to, XLY will probably be one of those first ones because again, in weakening economic conditions, people will definitely put off discretionary purchases. And this ETF is full of discretionary type stocks. All right. Another sign of economic weakness has been with us for quite some time. I've been writing about this, as I said. LGI Homes is of particular interest to me because they have a lot of business concentration in the South and big markets like Texas and I think in Florida maybe and South Carolina, North Carolina. Don't quote me on those, but I definitely know they have a good amount of home building in the Sun Belt where a lot of the economic growth has been. So the fact that LGI Homes has been so persistently weak among weak hope builders tells me again that if one of our strongest regions is slowing down, that's not good. That's a very bad sign for the rest of the economy. And LGIH has really been performing poorly. Very consistent downtrend all year, very consistent downtrend since September. If I pull back, incredibly, this formerly strong, hot home builder is pushing towards its pandemic lows. I mean, It's not, it's still a ways to go, but it hasn't been this low since 2020. Very bad. It's one of the weakest home builders on a relative basis in my universe. So it's really got my attention here. A discretionary play, Dave and Buster's Entertainment, otherwise known as Play, ticker symbol is Play, has finally woken up a bit. It had earnings earlier this month, and I believe it was down by, a little bit, fractional. It gapped up and then closed down a little bit, but buyers have been creeping back in. And I'm a holder of Dave and Buster's, primarily because insiders have been purchasing stock as recently as uh, in December after a very bad earnings miss or very, very bad post earnings reaction. So I've been sticking by it. The insiders have been sticking by it, all the way up to the CEO. The market doesn't appreciate it. I can't explain it, but I like to bet on the side of the insiders until proven wrong. Okay, finally, I haven't talked about the uh, quantum computing stocks in a while. I'm pointing out this one, IonQ, is my favorite, ticker symbol IONQ. I'm pointing this one out because despite the fact that it's very speculative, surprisingly, it has been holding strong above its 200-day moving average. And remember, the vast majority of stocks in the stock market are below the 200-day moving average. So I find it very encouraging that this quantum computing speculative stock is still hanging in there. Now, I'm not brave enough to buy back into it just yet, but I do have my eyes on this, and it's definitely stays on my shopping list. Note the danger sign or the warning sign here is that it's been unable to break out above its 50-day moving average resistance. If it does that, then I'll be much more encouraged to buy in. Okay, that's it for today. Thanks for checking out the market breadth and all this technical analysis. If you like more, subscribe to this channel. In the meantime, share this content so the algorithm knows that other folks need to see this. I appreciate your comments and feedback. I'll get back to them as soon as I can. You can always check out more details on my blog at drduru.com/122, all letters. And I will see you here or on the blog. Thanks again for checking this out and talk to you later.